All right, well, go ahead and get started and kind of make good use of everybody's time here. My name is Reed Myers. I'm the principal of Myers Investment Group. And today we have a great guest, Matt Moore. He is with self-directed IRA custodian called CamaPlan, primarily discussing kind of mortgage funds, how they're established, what they're about, things to be aware of. And Matt will go into a lot of details as far as self-directed IRAs, what does that mean, how to get one set up, what sort of opportunities can you invest in if you were to set up a self-directed IRA. Great, let's go ahead and get started. So as discussed, we're going to be talking about private mortgage funds, how these work, how they're established. Before we get started, of course, we've got some disclosures. Anybody can get a copy of this deck after the webinar. Just send us an email and we can certainly get that out to you. All right, so a little bit about me. My name is Reed Myers. I'm the principal of Myers Investment Group, as well as Myers Capital. Myers Investment Group, basically we're a capital management company, but Myers Investment Group evolved essentially from Myers Capital. So Myers Capital was a mortgage company, and that's one that we still run today. They correlate well because they kind of depend on each other to some extent. Myers Investment Group is meant to manage the capital that Myers Capital essentially deploys. So Myers Capital is a mortgage company where if you're looking for a mortgage, and we actually do residential and consumer mortgages here in Hawaii, most of our business is actually lending to real estate investors, developers, small builders, commercial property owners, and people like that. So that's the place to go if anybody's looking for real estate capital to borrow against your real estate. But of course, today we're mainly talking about Myers Investment Group and what we do as a capital management company. So just some background on me. I've been in the business for about 20 years. Started actually right out of college working for a real estate investment trust and kind of cut my teeth there, learning to do a little bit of investor relations, but did a lot of analytical work, just the grunt work and spreadsheets and things like that, and sizing up certain real estate transactions, primarily land development, retail repositioning, things like that. Myers Capital, our mortgage company, is actually a family-owned company. So we've been around for, I guess this year, it's almost 30 years. So getting pretty close. I haven't been there the entire time, as you can tell, but yeah, we're second generation. So we've been around a long time, but we're still a very small hands-on company, very boutique. And that's kind of the way we like it. We like to provide nice personal attention. I still personally love to get on the phone with clients and borrowers and help them through whatever they're going through in regards to their real estate needs. And we're based in Honolulu, but we actually lend in about 42 states. So we're very active throughout what we call the mainland, and very proud of that, kind of continuing our relationships all from Hawaii. And of course, we've had some presentation is not full unless you do a little bit of plugging about yourself. So we've been fortunate enough to be featured in some different publications here in Honolulu, as well as on the mainland regarding just how the mortgage industry has evolved, what we've gone through over the years, how we invest in technology, things like that. So we're pretty proud of that. We kind of already established this, but Myers Investment Group, this is our capital management side of our business where we manage capital for all our alternative investors. We call them also LPs, basically help them provide income-focused investments that all align with some sort of real estate component to it. I usually like to start these with kind of talking about some of the challenges that some of our real estate investors are kind of experiencing right now. And this is not anything new, but it's something that you start to realize as time goes on, I guess. And actually just today, I've got a portfolio of rental properties, and today I was on the phone for like an hour or two, and I have a property manager, but I still have to take time and energy to put into managing my real estate. It's never 100% hands off. So they can be exhausting. So sometimes our investors or our potential clients are getting to that point where they want to become more hands off. They like real estate. They understand real estate. They've probably done very well with real estate, but maybe they're getting to a point in their life where they want something more freedom that comes with it without giving up the returns and not allowing inflation to chip away at their portfolio. Of course, everybody has their perception on what the stock market is doing right now. One thing I think can be agreed upon, it's very volatile. Volatility, over the long term, usually things pan out, right? But as you get closer to retirement or are in retirement or at the point in your life when you are looking for fixed income, volatility is kind of the enemy. So we'll talk about that as well. Just as far as diversification, kind of goes without saying, you never want to put all your eggs in one basket, and diversification is incredibly important, either across multiple asset classes or multiple investment products. All right, so kind of honing in on what we actually do. Everything we're talking about today is going to be about lending to real estate investors, commercial property owners. Everything that we provide as far as loans is backed by real estate, aka mortgages. Advantages to that is your principal or our principal is actually protected by the asset value of the property. These are great investments for providing predictable cash flow, preservation, reduction in risk, and it also still gives you diversification. Right. So private mortgage investing basically is, there's a very big word and kind of headline news right now. You don't want to associate private mortgage investing with just private credit. So you may be reading a lot in the headlines about how private credit is going through challenges and there's basically blocks on the ability to get your money and things like that. That's not what we do. So private credit generally has to do with lending to, this is a larger institutional level where hedge funds, large capital aggregators and managers lend money typically to businesses. And generally there's no underlying real estate component to it. So we strictly deal with real estate. So this is technically it's a subset of private credit, but it's private mortgages. So there's always going to be some hard collateral, hard asset backed by it. The way it typically works, high level, basically borrowers make their interest payments, interest comes in. We have, of course, before we close, we put a mortgage recorded at the appropriate courthouse or the county level, putting a recorded lien on the property, just like any other mortgage that I'm sure many of our viewers have taken out in the past. Income is provided usually monthly, and it can be quarterly, just kind of depends on how a fund is set up. And of course, you got all the passive nature that comes along with that. All right. Private mortgage funds specifically, what is this? So if you think about a mortgage and a loan, right? We lend somebody money, a real estate investor, and we lend them, let's just say 50 cents on the dollar. So let's just say the property's worth $1 million. We lend them 500,000. That's going to be one mortgage, right? So a pooled fund is essentially multiple mortgages, theoretically similar in type and management and how they underwrite. But what you get when you invest into a fund, you typically get professional management. So management is like, how do we underwrite the loan? How do we even decide to lend this real estate investor the capital? What is going into our decision making? Then you have kind of post-closing, after we've decided, yes, we will lend them the money. We close on the loan, there's what's called asset management. So that's kind of continuous and ongoing. Underwriting is typically done on a deal-by-deal basis. Private mortgage funds generally can provide multiple income streams from multiple sources. Why? Because there are multiple mortgages within a fund. It also allows the fund manager many times to scale more quickly without giving up diversification or amplifying risk. So it's just a much more efficient vehicle rather than doing one-off deals. And we'll kind of talk about that later on. So we talked a little bit about how mortgage funds are generally structured. The general flow is investors will put their money into a fund. They sign what's called a subscription agreement. They will review a PPM, private placement agreement. They maybe even look at the operating agreement. But basically, it's a legal entity that's set up, and it's the PPM basically provides all the instructions of what the fund is allowed to do, what it's going to do, and provides all the risks. So all these, of course, are written by securities attorneys. So they're very in-depth, but at the end of the day, it's meant to really give full disclosure to the potential investor, as they're generally called LPs, limited partners, into what the fund is doing, what it can do, what it can't do, what are the risks, and how investors give them the decision-making information the information that allows them to make the right decision if this is good for them or not. But basically the way it works is once an investor invests into a fund, usually the fund manager then now has capital to work with. From there, they can then start to look at deploying that capital out and lending it to appropriate borrowers, right? Once those loans are originated or closed, meaning they've lent them the money, right? The borrowers have signed on the dotted line. Then your interest income will generally flow into the fund. And just like any other business, a fund is a business. Core basis, it's essentially a business where income comes in, it generates revenue, and it will have expenses. So general expenses, every fund can be different, but general expenses are usually your legal, accounting, your fund administration. Many times fund managers will have what's called a fund administrator. And what they do is kind of manage all the ins and outs. There's a lot of money moving in and out in between funds where new investors come in, loans get paid off, so new capital comes in. But fund administrators in my opinion, they're a very important part of managing a fund properly, and it allows the fund manager to have multiple sets of eyes looking on the operation of the fund and the business itself, and kind of helps keep everybody in line. So it really is an advantage when a fund has a fund administrator. It's really an advantage not only for the fund administrator or for the fund manager, but also the investors. So those are just some typical expenses. And then depending on how a fund is set up, revenue comes in, expenses go out, depending on what's called the waterfall, which is how investors are paid out. At some point after expenses are taken out, then calculations are made, and then investors get paid out as well as the fund manager. It's typically how it works. Okay. So there's a lot of things to consider when looking at funds. I'm really kind of going over high level of things that, like, if I were first getting started as an investor, what to look for when looking at different funds to see if this is a good fit for me. And these are some of them that I personally have guided certain investor clients of mine to look at and help them determine, like, hey, you need to understand that these are these are terms that you need to understand and look at, because it can have a very big impact on how this relationship progresses. So first one is what's called a lockup period. So the best way to think about that is a CD. So certificate of deposit, right? I think many of our viewers are probably invested in a CD at some form or another. I have as well, before I realized there's a lot better investments out there. But it's a very safe place to put your money for a certain period of time. So CD typically it could be a 1-year CD. So what does that mean? Well, you really can't get access to that money within a year without paying a penalty. So think about it like that. Now, some funds might go deeper into saying, you just can't get access to your money before 1 year, or they might have language in there that says you can ask for it and we can do our best. It's kind of discretionary, right? So a fund manager always has to deal with what cash has already been committed to us, what cash is sitting in our bank, and what cash do we need to deploy to earn our returns for all of our investors. And depending on how it's set up, you have to make very frequent decisions on when to deploy capital, when to keep it in. If they're sitting on a certain amount of cash and they're getting ready to deploy it on, in our case, like a loan, and an investor comes in and says, I need my money back, it's an emergency, we might not be able to do that, right? So it really kind of depends, but it always goes without saying, look up the initial lockup period, make sure you're comfortable with that, sure it meets like what your timeline looks like. Is if you're investing some capital and you're going to need it, there's a possibility you might need it next year, and the lockup period is 1 year. Don't invest, right? It just doesn't make sense. It's not worth that potential inaccessibility. Piggybacking on that, some funds will also have what's called an advance notice requirement. So this allows, again, kind of ties into what the fund manager, the advance notice that they need in order to process a redemption, as it's called. So if an investor wanted their capital out, even if they're beyond the lock period, if they wanted their capital out, they need to give a certain amount of notice to the fund manager, and then the fund manager has a certain amount of time to process it. So, and then even further, some funds will have scheduled redemption windows. It's pretty self-explanatory. They say, well, okay, you can only request a redemption one time after the lockup period, maybe once a quarter, something like that. So because of all this, a lot of funds will talk about how they're structured as semi-liquid. So liquid, obviously meaning quick access to your capital. The most liquid is obviously cash in a bank or in your mattress. Funds like this are typically labeled as semi-liquid because most of the capital being deployed is on short-term loans. So even though it is being invested, it's set to be paid back in a short period of time, I guess is the point. So semi-liquid is what we generally classify mortgage funds under. All right. One important distinction is a fund model versus direct mortgage investing. So direct mortgage investing, we didn't really talk about that too much. That's not the main topic of our webinar today, but the way we define it is essentially investing into one loan instead of a pool of loans, right? And there's also some other common terminology called first trust deeds, where you actually own the mortgage itself, either the whole thing or possibly a fraction. And once Matt takes over the presentation, he'll be talking about that as well. But it's important because you have direct mortgage investments, your concentration level is obviously higher. You're into one deal specifically. It's less diversified. But with that being said, we have some investors that prefer that, right? They just prefer to have their hands on. They know where their money is lent. It's lent on this one deal. They can know it. They can maybe drive by the property if they wanted to. It's more real to them. It is more hands-on, so there's more friction involved in getting in. There's a little bit more responsibility in getting out. You do need to consider things like, well, what if the borrower needs an extension? Am I willing to do it, right? Or am I comfortable, and do I want to even having to deal with pushing the fact that he's defaulting? Some of these loans, by the way, again, depending on the lender and how they're writing it, they're short-term in nature, and a borrower can still make their payments on time every month, but the loan matures. And, common for the industry, let's just say, is 12 months. When the loan matures, if they need an extension, you as the owner of the mortgage may not want to grant it to them. And that's always your prerogative. And depending on how the loan docs are written, it's probably within your rights. You could actually foreclose on them. But you have to make a business decision whether or not it's worth it or not. So a lot of times, and that's kind of just a little bit of what I'm talking about when you're more involved when you own a mortgage, right? You have to make a little bit higher business decisions on what to do or what not to do. For us as a company, we guide you on all that. We're still helping you manage it. But ultimately, if you own a mortgage yourself, you actually have to make that decision. In a fund, as opposed to a fund model, you don't make any of that. That's the fund manager's responsibility. Minimize risk, make good business decisions across the board, maximize return, keep things diversified, and try not to be overweight in certain asset classes, etc. So anyway, pros and cons to really both sides. All right, so on this chart, basically, we're kind of going into a little bit about how mortgage funds relate to credit funds, private credit, aka as we talked about earlier, as well as maybe an equity fund or a real estate syndication. So a lot of people have heard of real estate syndications where money's pulled together, kind of same concept, right? It's managed by a GP or a general partner, and their job is to go out and buy real estate, right? So another great strategy, again, there's just differences along the board in every level here. So mortgage funds, obviously, we were lending out real estate loans, credit funds. This is more corporate or can possibly even consumer credit. And real estate funds, basically, your money is pulled together with other investors as the equity part to go buy real estate. And on this next few slides, equity is not debt, right? Equity is actually riskier than debt, but there are certain advantages as well. So I'm not going to go through everything here, but this is a very good chart to kind of understand and get comfortable with when you're deciding what kind of alternative investment fits best for me. All right, so we kind of alluded to this just on the last page, equity versus debt. So equity is essentially, let's talk about buying real estate, right? When you buy real estate, maybe you're going to get a mortgage, but most lenders are going to require a down payment, right? So a typical deal for us, we would see something like this. Maybe $1 million purchase price. We'd require the borrower to put in $400,000. This gray area is not usually a part of our general structure, but it's important to see that so you understand where subordinate financing is in the capital stack. The higher you are on the capital stack, the more risk there is. The riskiest is equity. Lower on the capital stack, first mortgages, also called senior debt. This is the less risky place to be in what's called the capital stack. Subordinate financing is slightly riskier than us, but not as risky as equity. So back to the other chart, real estate syndication, your money is pooled together with other equity investors. That's equity. That's the orange. Private mortgage funds, we're in the green. And most of our liens are, in our case, most of our deals are first lien positions. So we're clearly in the green. Occasionally we'll have a second here or there, but that's not a big part of our business. So anyway, it's important to understand that higher you are on the capital stack, more risk, lower, less risk. And this is generally where most mortgage funds will fall. All right, so why is that important? Understanding equity versus debt. So this chart right here kind of goes over like what could happen if when you're comparing an equity investment, real estate syndication compared to a debt syndication or mortgage fund. And what could happen if the market declines, let's just say by 15%. So kind of using the same example, $1 million property, we made the borrower come in with $400,000 down payment. We lent the borrower as a first mortgage $600,000. And if the market declines 15%, your $1 million property now declined to $850,000. So who loses out here? It's actually the equity investors. Well, or the equity or the owner of the property came in with his own money, so to speak. So it doesn't affect our debt, right? The whole value of the property dropped by $150,000. But our debt is still secured. Now, our risk actually has gone up because now our $600,000 against an $850,000 property, but we didn't lose any money, right? So our risk factor has gone up. Our loan to value started at 60%, but when the market value dropped to 850, we're now at 71. So our risk factor did go up, but we didn't lose any money. What was lost? It was actually the equity investor. So, I mean, this is a pretty big decline. So, take this with a grain of salt. Again, it's not meant to be anything against buying real estate, like real estate acquisition or equity is bad. It's just important to understand the capital stack and where debt is and how this is just by facts, less risky than being a part of an equity type investment. But again, there's other considerations that you want to take into account. All right, I'll kind of go over this just real quick, but how is the mortgage lending world doing in the private realm right now? Generally still seeing continued banks to be continually tightening and restricting based on what they're doing. We might even see that more with the kind of private credit challenges that are going on right now. But bottom line is private mortgage capital is still continuing to grow. We still have very much a place in the market where long-term debt that's issued from banks, larger institutional companies, life insurance companies, there's a place in the market for private capital. And that's on a very small scale, that's where we fill in. Okay, so rising rate, changing rate environment. Well, how does that affect a mortgage fund? Basically, for us personally, for our capital that we're deploying, it's very opportunistic. So we're lending to people that are in certain situations that need the capital, and they need speed over the best rate, right? And I always tell people too, and I always try to help my borrowers if they can qualify or have the time to wait, or they can get their property to a different stage in its progression. Maybe they're renovating it. It's like, if you finished your renovations, if you can pull it off on your own, I can get you a much better loan than these private mortgages. But if they don't have a choice, they need to do it. Very few other lenders are willing to lend on them or get creative. They really have to pay the market rate. And, for us as a company, our note rates on our mortgages for bridge loans are basically like 13 or 14%. So it's not low by any means, but I say, this is what we need to charge to pay out our capital investors the rate of return that they're looking for, which is, most of our audience here. So as far as rate, I would see we haven't seen a lot of fluctuation yet. I'll talk of rates coming down. They have come down a little bit past 3 years, but nothing extravagant. In fact, in the past few weeks or month, they've gone up quite a bit with bond yields rising. So there's always going to be a place for high cost debt. So because investors sometimes need to move very quickly. Their property's in a repositioning phase, whatever it might be. They're waiting on some other property to sell before they get liquid, and they need to borrow against this equity that they got in the existing property for many, many different reasons. So I don't see this fluctuating too much as far as going up or down. And right now we're pretty flat anyway from a long-term perspective, at least in the past few years as far as rates goes. So yeah, and there's always been double-digit private mortgage rates in the past. So we're not really seeing that on our end changing quite a bit. All right, we talked about comparing mortgage funds to equity real estate syndications. What we haven't talked about yet is what happens if your money's in the stock. Okay, so basically what we're going to talk about here is a theoretical scenario, $500,000 in an IRA. What would your portfolio look like if the market would continue to grow at an average 10% return? And what would it look like while that's happening, that you are now needing to take out or choosing to take out a 4% withdrawal every year? Maybe you're in, your retirement mode, or you're needing to take out RMDs, required minimum distributions. How does your portfolio perform in the event of a pullback? So here this is the stock market scenario. So scenario one, everything's doing well, right? $500,000, maybe you're earning an average 10% return every year. You take out an annual withdrawal of 4%, that's 20 grand. You're left with still 530 grand at the end of that first year. So your portfolio still grew. Great. Everything's going fine. What if it's not going fine? Okay. So in the past 20 or 30 years, we've had 6 declines of 20% or more. So it's a very real possibility. Let's see here. I think the last one was 2022. So these are the years that we've had 20% declines or more. So if that happens and you're still needing to take out money to live off of, right? What happens to your portfolio? Drops 100,000. You still need to take out your 20,000 to live off of, or your RMDs or whatever it might be. So now you've in a way kind of decimated your portfolio for the foreseeable future. So these are the kinds of things that a lot of our investors are concerns for them, and it's why they're looking at more income-focused, asset-backed investments like a mortgage fund. So this is what it would look like. This is the scenario one, everything's going well. And scenario two, it's almost like things will never catch up, and it might eventually, but especially if you have better years than the 10% return. But you can see how big of a hit that can happen. And so this is especially important for the retirees, right? For those actually needing to take out capital out of their accounts, it has a tremendous effect. Okay, so now we take the same scenario, apply it to, let's just say, a mortgage fund that's earning 11%, and that's very realistic numbers. So you start at 500,000, you earn 11%, you earn 55 grand, you still take out your 20 grand in RMDs or distributions. You're left with 535. Great. The beauty of most mortgage funds, and for us on our direct investments, is that the advantage is these are very consistent. And even if the consistency fails to some extent, like you need to foreclose, which, by the way, in our case, our delinquency rates are like 1% to 2%. So it's very, very low, but that's always a possibility. There's a liquidation event, right? You take back the property, you sell it, and, theoretically you don't lose principal. And I can't speak for other funds or other private mortgage aggregators or lenders, but for us, we've never really lost any principal on most of our deals. It's always, once you go in and you're conservative enough, there's always an asset there to protect your principal. It is theoretical, it could happen, but for us, it doesn't happen very often. But 500,000 here. So it's essentially, the argument is that things can be consistent, right? So you can either choose to allow your account to just grow faster by still taking your 4% withdrawal. Another way of looking at it is you could actually take out a much larger withdrawal every year and still maintain the same balance of your portfolio. So instead of living off of this or supplementing your income off of this, you could actually supplement your income up to this amount and still have a break even on your portfolio. So that's just a way of looking at things as far as what more of a fixed income type investment at 11% returns could actually, how that could change my financial future, right? Especially if you're taking out distributions. And then this chart kind of rams that point home. All right, so we're finishing up tail end on my side, but conservative loan to values, as far as our portfolio goes, our average LTVs, like what we lend on in relation to the value of the property on every deal, is 50 to 60%. That's important for you to understand as an investor. What kind of LTVs is this mortgage fund providing or lending on? Also, it's not on here, but the size of the loan is actually very important. Basically, when a lender or a private mortgage company, aggregator, or fund manager, when they lend money out to an investor, you could have the same 60%, let's just say, loan to value if somebody lent them 60 grand on a $100,000 property. For us, we don't like to do that because that's only a 40, as a percentage, it seems great, right? 60% loan to value. I got 40% of equity protection there for my money, but it's only $40,000 in this case. So we don't like to lend on these very low value properties because of that. So that's an important distinction that I always bring up when doing my suitability calls with investors is who we lend to, what kind of leverage, loan to value, and what size dollar increments are we talking about. So we prefer to lend $600,000 on $1 million property and have $400,000 in equity protection, rather than lend $60,000 and have $40,000 in equity protection. So that's kind of the realm that we play in. Everything else here we kind of talked about, but independent appraisals, we always get valuations on our properties before we lend the money. We highly vet out the business strategy of the borrower, what they're doing, right? How they're going to turn around this property, what's their experience. And with a fund specifically, fund managers should always be looking at their portfolio allocation. They don't want to be too overweighted in certain asset classes, certain property types, overweighted maybe even in certain states, but also different dollar amounts of loans, right? You don't want to have too big of loans in your portfolio and you don't want to have too small, right? You want to, depending on their mandate, they want to ideally keep that diversification in check. So very important. Matt, go for it.
All right. Awesome. So I'm going to speak pretty quickly just because I know we have a chunk of time here and I want to be mindful of everyone's afternoons and mornings for those of you in Hawaii. So my name is Matt Moore. I do business development at CamaPlan. CamaPlan is a self-directed IRA administrator. Before I get too far ahead of myself, we have our disclosure too. Anything that I'm going to talk about in this section is meant for educational purposes only. So for tax related decisions, go seek out the guidance from the appropriate professionals. CamaPlan is in Pennsylvania, Ambler, PA to be exact. We're about over 20 years old. We have somewhere in the neighborhood of about 7,000 to 8,000 clients across the country, including Hawaii. And we are really big on customer service. Our owners are themselves. They deal with a lot of financial services professionals. They don't like being put on hold. They don't like dealing with complicated phone trees. So they've made CamaPlan a place where when you call, you can get a real person and you can get an answer quickly. So it's a big part of the business. Another big part of the business is education. A lot of people are new to self-directed IRAs and they want to understand how it all works. So we do lots of educational series like what I'm doing today, as well as one of our co-owners, Carl Fisher. He provides education in a continuing education format to advisors, CPAs, real estate agents, folks like that. So I like to just start first and foremost by understanding providing some baseline information about what is a self-directed IRA, because like I said, not everyone knows, or maybe they've heard about it and they're still new to it. A self-directed IRA isn't something that has its own set of laws or something that is its own species of retirement account. The IRS tax code actually allows for a wide range of investments inside these qualified tax plans, these retirement accounts. And so a self-directed IRA, a truly self-directed IRA that we provide, allows investors to invest in private or alternative investments that they wouldn't necessarily have access to if they had an IRA at a Charles Schwab or a Wells Fargo or Fidelity, someone like that. And what this enables the investor to do is to use knowledge that they might have built through their career and leverage that knowledge and that expertise to do their own due diligence and participate in some deals where they're going to be able to really find an opportunity that they could only get in a private market. One of our clients actually has a great quote, and this is he's a former real estate broker. He had an IRA that was in mutual funds, and it was fine, but he wanted to use that career of real estate that he had built and leverage it to be able to improve his portfolio. And so he said it's about investing in what you know, understand, and can control versus using hope as your strategy. And in his case, hope was referring to the stock market, which he felt like that's as best as he could do. But, we don't have anything against the stock market or that types of investing. There's a place for it. And if you're good at it and you make money in it, that's fantastic. But we see that self-directed IRAs are a way for you to have more control, have more diversification into how you grow your nest egg. There's basically two buckets of self-directed plans, and it comes down to how you are going to be taxed. Do you want to tax the seed, or are you going to tax the crop? What I'm talking about here is taxing the crop is tax deferred versus taxing the seed is going to be post-tax money. So tax deferred, the most common one account there is going to be a traditional IRA. And on the tax-free side, it's going to be the Roth IRA. And these are the two most popular accounts at CamaPlan and probably most IRA providers. But there's several other kinds of accounts that you can self-direct within. There's employer-based accounts like the SEP IRA, Simple IRA, or Solo 401k. And then on the tax-free side, if you want to do self-direction for, health expenses or for educational plans, educational bills that are going to have to pay, you can self-direct as well. I mentioned earlier kind of this idea of giving you more control. RMDs, as Reed mentioned, that's another area where you can have more control when you're using the Roth IRA specifically. So on the tax deferred side, you have required minimum distributions. And if you're making investments into private deals, which may be illiquid, that's going to take some strategy to figure out, okay, how will I be able to cover my RMDs if I'm investing into a real estate or an equity fund that has a 7-year hold? It's not that it can't be done. It's just you need to consider it. On the Roth IRAs, though, they don't have required minimum distribution. So you're able to kind of not have to think about that particular aspect as much. There are many types of investments that you can do in self-directed IRAs. These are just kind of the short list of things that we see often at CamaPlan. On the real estate side, we have investors who own single family homes, vacation rentals. So they're owning apartment buildings, they own land, or they own properties outside of the country. Lending is very, very popular. It can be structuring a loan yourself or originating a loan yourself. It can be buying a note. It could be investing into an individual note. So I think this is one of the most powerful aspects of self-directed IRAs, is effectively being the bank. Private placements, also very, very popular, probably the most popular right now in kind of CamaPlan's history. People really like this because it gives them the opportunity to invest as an LP, invest passively into a real estate fund or a real estate debt fund or something like that, that is giving them better returns, but still allows them to maintain that a more passive relationship to the deal that they were accustomed to when they had their 401k. So a lot of people don't necessarily want to be making investment decisions every single day or every single month, but they want better returns and they want investments that are backed by hard assets. So private placements is a kind of a nice best of both worlds solution. And then precious metals, very popular with our clients. People like the long-term strategy of holding precious metals and it aligns well with IRAs. There's a couple of things that you can't hold inside of an IRA. There's a few nuances here and there about certain asset classes, but really the two main things that I like to focus on are collectibles and life insurance. So no life insurance policies inside an IRA. And then with collectibles, think baseball cards or bottles of whiskey or rugs. You can't hold those. But even still, there are funds out there that have securitized these, and you can still invest in a fund that holds works of art or whiskey funds. So even with these prohibited investments, there's still ways to participate in them. On the other side of the prohibited coin are the prohibited transactions. And the best way to illustrate these is to talk about real estate. So if I'll use myself as an example, and let's pretend that I buy a property in Los Angeles. It's near USC, and that'll make sense in a moment. But I have this property in Los Angeles, and I need to go, the toilet needs to be replaced on it. Well, if I own it, I can go and replace that toilet. But if I own that property inside of my IRA, I can't go and make that repair myself because, as you can see on the top or the second bullet, there's no self-dealing. So what this means, really, the whole theme here is that everything has to be at an arm's length. And so my IRA, which is its own separate entity, can't benefit from my sweat equity of me replacing the toilet. Conversely, if I want to go and take my kids down there because we're going to go to Disneyland, I can't go and stay in that property because I'm not allowed to get a benefit from it either. So just something you have to keep in mind. This also applies to certain selected family members. So using my example, let's say I have this 4-bedroom house next to USC, and I plan to have three college students stay in it. I'm going to have my daughter stay in the 4th room. Well, she can't, because anyone who's of lineal ascent or descent is also not allowed to benefit from your IRA. And what that means is parents, grandparents, your spouse, your children, grandchildren, any of their spouses. Now, the flip side of the prohibited transactions, specifically with family members, is that you can partner with these individuals when investing in deals, or you can partner with your IRA's money and yourself when investing in deals. A good example of this is if you had a fund that had an A tier, a B tier, and a C tier, and there were more favorable returns in the B and C tier, but they had higher investment minimums, you could take some IRA money and take your own personal money and combine those together. And if the sponsor's okay with that breakdown, then you can participate in the deal that way. The IRS is okay with you doing that when it's at the time of the investment. Or if same kind of scenario, if you took your IRA's money and you invested it with your wife's IRA money, then you could potentially invest together and get a more favorable return in that investment. So something to keep in mind. I've talked about, what a self-directed IRA is, and I gave you some examples of what you can do and what you can't do. I like to kind of break it down a little bit, take life outside of a vacuum and actually show what you can do with an IRA in kind of like a real scenario. Since we were learning about the mortgage, kind of like mortgage fund, private mortgage funds, I gave the example here of investing into individual mortgage notes. So I'm familiar with the term a fractional participation in a note. It goes by different names, but effectively there is a mortgage note and you can invest in these depending on the investment minimum for a portion of the total principal that is being lent to the borrower, and then you get a return that's arranged through the private placement memorandum of that deal. And so looking at this investment, we're going to assume there's an 11% annualized return. We're investing $150,000, and I'm assuming a 37% tax bracket for this investor. And on the blue column, you have investing through a Roth IRA, and on the green column, you have investing through non-qualified funds. And so at the end of the day, the Roth investor is going to be able to keep about $6,000 in their account, whereas the non-qualified fund investor is going to have to pay that money to Uncle Sam. It's pretty nice. 12-month hold, you're up $6,000. But if you were to continue to do this over and over again, and you just redeployed that money that you were earning, you can see that on the blue line, the Roth IRA investor really starts to move away from the non-qualified fund investor. So it's just kind of something to keep in mind that there's a lot of power to using the qualified funds inside these investments that, have attractive yields, especially as you're thinking about year-over-year deployment. How does the process work? Well, we try to make it as simple as 1, 2, 3. There's a few other things that happen in the background, but for you, someone who's interested in opening an account, it basically boils down to these 3 steps. First, you're going to open and fund your account. That's done 15 minutes on our website. It's pretty short. And during that account opening process, you're going to indicate how you want to fund your account. And usually the common ways to fund the account are either rollovers or transfers. You can contribute new money, but often when people are opening up account and they're going to be self-directing into a fund or something, the investment minimums require $50,000, $100,000, $150,000. So people are funding this through a rollover or a transfer. That process to get the money from your existing plan administrator or your existing custodian over to us generally takes about 2 weeks. While you're doing that, you can fill out the investment paperwork that might go along with it or start getting the documents that go with your investment for that transaction. And if you're working with an investment sponsor, a fund manager, we're more than happy to work with them. We actually prefer it because generally we are speaking the same language and it makes it a lot easier for you. We get the investment document signed. We also have you sign or fill out what's called an asset purchase directive. It tells us how you want to invest your money. Once the documents are signed and your account's funded, then we turn around and fund your investment within 48 business hours. And then your investment is active and the distributions from that, any capital distributions, they go back into your IRA. In summary, we do a few things. First and foremost, the IRS requires that there be a third party to administer these accounts. So we check that box the same way that a Fidelity or Schwab does. And we keep all records of all transactions, report those to the IRS, things like 990Ts or fair market valuations. But beyond that, we want to be a part of your core financial team. We want to be a part of the dialogue with your CPA, with your tax advisor, whoever you're working with to paint your financial picture, because we know that not everyone knows about self-directed IRAs and that sometimes can include professionals. So we want to be able to make sure that we're having everyone on the same page and everyone understands what's going on with these. And the last thing I would say is we are a neutral third party. We're not allowed to sell any investments or promote anything, but we look at that as a value add because that means that when you come and talk to us, we're going to tell you how great self-directed IRAs are for sure, but we're not going to be pushing any kind of investment on you. And that is it.
A couple of recent case studies. So this just gives you a sense of what kind of deals that we're doing. If you ever wanted to take a look at anything, direct investments, these are some of the deals that we've closed. The way we work typically, by the way, when it comes to our directs or fractionals, as Matt mentioned, you have a total loan amount size. You don't need to invest the whole amount. I mean, you can take the whole. I have some investors that take the entire loan. Minimum investment on ours for our direct investments is $150. So in that case, obviously, if you took something like this, you would own $150,000 of the $740. So you'd own a fraction of it. Many times once we open our direct investments up to our capital investor base, we've already lent them the money. So we actually have already deployed our company capital and closed on a loan. The borrower may have already even paid a payment or two, and now we're just opening it up to investors if they want to participate. So we're very comfortable and very confident in what we've already done because we've already lent them the money, and we have no problem earning our rate of return on it as well. But it doesn't help us kind of continue to grow our capital base. And for us, it's about relationships, and you do well, we grow together. And we sometimes we don't take on new capital too. Sometimes we're very picky on like who we lend to and what situations. So there are times when sometimes we're not even taking on any new capital. But when we do, we put it out like this, and you'll get the whole what's called due diligence package. If you're interested in investing, our website has more of the up-to-date ones. I actually don't know yet if this one is completely taken off the top of my head. The way it typically works is if you're interested in looking at any of the ones on our website, by the way, is passivereturn.com. passivereturn.com. You can go to active opportunities and see more updated of what's available. You sign an NDA. We send you over the due diligence package of the deal, and then you let us know if you're interested, if you have questions, and I can walk you through it if needed, and then you decide if you want to invest in it or not. So this is one we closed not too long ago. Situation was we have a seasoned real estate investor here in Honolulu. He was in a quick time frame. He had to 1031 out of another property. 1031 exchange, usually the timing is very important. You have to redeploy that capital from the sale of the 1031, the exiting property over, and you have to redeploy it and put it into a new property. Otherwise, you're subject to the long-term state and federal capital gains. He was denied by another lender, not because there's anything wrong with him. The property had a little bit questionable. Like when we do long-term loans, I do long-term lending as well. The property needs to be pretty good shape. You can't have, in Hawaii, you can't have wood rot, termite damage, peeling paint, even small things like just a little bit of paint coming off the siding. I have one right now where there's a little bit of paint chipping off the ceiling, and my underwriter says, we got to get that fixed before we're closed. So sometimes it's a little ridiculous, but in this case, timing was of the essence. So back to that kind of scenario, timing is of the essence for this investor. We got him closed. I don't know. It was very quick, maybe like 2 weeks, 2.5 weeks, something like that. We lent him $740,000. The property was appraised at 1.175. So we're at 62% loan to value. This is a short deal, 6-month term, and this is yielding our capital investor 10. So if somebody invested the full 740, they would earn, $6,400 a month on this. All right, going over to Maui. So this was a developer / doctor. He's a doctor, but also does some development. So experienced, he had a hotel conversion project he was working on. He needed to bring in a little bit more capital to get it to the finish line. So he needed about $500,000-$600,000. He had properties free and clear, Lahaina and Hana, both two beautiful places. Lahaina's actually, a lot of it's being rebuilt right now. So this was actually a residential lot in Lahaina and another lot in Hana, both on Maui. Free and clear. We agreed to lend him $600,000. We appraised both of the properties at $1.285 million. Our loan to value was about 46, less than half, and our rate of return on this is 11.2. So if somebody invested the full $600,000, they would earn $5,600 a month. And he's made maybe 2 or 3 payments already, all on time. So yeah, that's another good example. I think we got one last one in Hawaii. This was a great one. Really great guy, client, very nice, very smart. He basically owned the property free and clear, just wanted to borrow $250,000. It's valued at 2.3. This one has been taken, as you can imagine, because the return is good. Loan to value is very safe. But yeah, he just needed the capital to he wanted to put the property on the market, just finish up doing some nice touches to get a premium on it. And it's been performing very well. So $250,000 investment, rate of return 11%. $22.91 a month. All right, so going over to the mainland. So this was in Minnesota. This was a seasoned investor. So it was a 5-unit. So it was like 2 duplex properties with a single family home, all on one parcel. So legally 5-unit. He needed to refinance to, I believe, this has been a while ago, but I think it was to kind of fix up one of the properties. He had a very low loan on it at the time, maybe like a couple $100,000. So we lent him $400,000. Very low loan to value, 50%. Rate of return 11%. 12-month term, and this loan is performed the entire time. So that's your monthly income on that one. All right, that's it. Yeah, if you have the time and you want to shoot me an email as well, comments, feedback, things maybe you want to know more about next time, that'd be great. We really appreciate it. So thanks for attending.
Thank you. Thanks for the opportunity.
Thanks, Matt.